For this special Motor Trade Radio interview, we're joined by Daksh Gupta, CEO of Marshall Motor Holdings, who's here to talk to us about the group's interim results for the first half of 2021. So welcome back to the podcast, Daksh.
Hi Curtis, hi Phil, thanks for having me back on.
It's great. I mean, you probably had a very, very busy day, I think, after a long day.
It's been a long day, that's for sure. I think I went to bed about 2 a.m. last night, and then the alarm clock went off at about 4:45 this morning. So, yeah, you tend to have a few very intense periods in the year, and this is one. In fact, interims I think are worse than results because you close the half on the 30th of June, and then literally, we're out on, 10th of August. So, it's 40 days later, you've got to get it done. Whereas at least with results, you don't kind of go until the first week of March. So you've probably got an extra 3 weeks. So, this is probably the most intense period.
Are you getting a holiday after this time or not?
No.
Okay.
But Dash, we are flattered that you started the day on the Today programme on Radio 4, and you're finishing the day with us on Motor Trade Radio, so thank you for that.
Well, actually, I have to say, I did start on at 7:15 this morning on the Today programme, which is quite a well-respected show. I'm not quite sure what I was doing on there, but anyway, we then had BBC News, Telegraphs, Evening Standard, and then 5 Live, one of my favourites, this afternoon, and then save the best till last for you guys.
That's it. He was thinking of us having a lie-in, Curtis. That's what it was, you see. He didn't want to...
He thinks of everything, yes.
Exactly. I mean, to get things underway, and you probably know, well, you will know it all off the top of your head, but just to get things underway, if you describe the interims as exceptional, and I think that's the tone that's coming out today with record underlying profit of 38.4 million. Do you want to just sort of take us through some of the regards as the main highlights from the interims produced today or publicised today?
Yeah, so, I mean, look, absolutely stunning set of numbers. I think the sort of real highlights are, record revenue, record gross profit, record profit before tax, record cash position, record net assets, record dividends. So, a few highlights. I think the thing I would say, though, we've got to absolutely keep our feet on the ground. We, along with the whole sector, have enjoyed some exceptional tailwinds. And if anybody starts believing their own hype with some of these numbers, then, I think they need to take a dose of reality, because we have not overnight turned into the gods of automotive retailing, that's for sure. So we have all enjoyed exceptional market tailwinds. I'm sure we'll talk about that later, but clearly around the used car market. But whilst we have benefited from that, I've got to take my hat off and give total credit to my teams, because they've done an amazing job. And that's because we once again outperform the market across all of our key KPIs. So if we look at some of those numbers, revenue up 49% to 1.33 billion. Again, got to remember that the results last year were impacted by the pandemic, and the first lockdown was clearly a lot tougher than I think as we worked through lockdown 2 and 3. But let's not forget, we were shut for more than 3 months in H1 this year. So that 49% was a stellar performance. And just as a reference point, we were actually up 13% in 2019, which clearly had no pandemic distortions there. Record gross profit at 11.8%, and that was again as a result of the used car dynamics that we've talked about. And then our previous record for profit was 16.2 million, and this number tells you how well the business has done. We reported underlying profit before tax of 38.4 million, which was just quite frankly incredible. The group's balance sheet is really strong. We've got no debt, as you know. We've got no pension deficits. And we've got an adjusted net cash position of just under £60 million. Balance sheet's now nearly 240 million. And given that we paid back furlough and we paid back retail grants, we've restored dividends today with a very handsome dividend for our shareholders of just under 8.9 pence per share. And that's just the interim dividend. Across the board, outperformance on all of our key metrics. So new cars up 46%. That's nearly up 7%. Versus the market. Within that, retail was up over 6%, fleet units up over 17%, and that's all on a like-for-like basis. And again, you've seen the SMT release the market data for transactions today, which was up 33%. And again, interestingly, Auto Trader said, which is probably more comparable because they don't include private transactions or write-offs, which the SMMT data does. They showed it was 31% up. So our performance, and this was the real standout for me, we were up 51.7%, which was outstanding, quite frankly. So that's the highlights for me, and there are a lot to talk about there.
Well, Dash, just focusing on those vehicle sales for a moment, can you just take us through what generated the growth you saw across new, which, as you said, was up 46% year on year, and used, which was up 52%, especially in light of those SMMT figures you just mentioned? There's considerable outperformance there.
Well, I think in terms of what's been driving this, obviously, the market dynamics is probably the most bizarre that any of us have seen, and how to predict this is crazy. But I think, as I said earlier, we can't take the credit for some of the market dynamics, but it's that outperformance is the bit that we can absolutely sort of look ourselves in the mirror and say we've smashed it out of the park, because that's what I judge my team on. That's what I believe that people look at when they're benchmarking businesses. So I think, for us, we've got lots of things that have been in place in the business for many years. I mean, it's my 14th year as CEO. Curtis, I still remember you interviewing me back in 2008.
Yes, you were the new boy.
I was the new boy, still the new boy. I only just turned 50, remember? So I think, look, we've got a really stable management team. We've got a great management team. We've got great culture in the business. 7 years, great place to work status. We've got great technology, which is with our in-house developed platform, where we use data analytics to run the business. And we've really focused. I think there's a big thing to say about focusing on key things that you want to get done, and that's what's delivered the performance that we have, really. And I think, as I said, credit to the business. They've done an amazing job.
And I noticed in the details of your interims, when you were talking about new car sales, you talked about the margin, the increase in margin, which was on the back of hitting OEM bonus targets.
Yeah, so I mean, last year, if you think about when the pandemic hit, it hit on the 23rd of March. So as you know, as an industry, we sell all of our cars in the last 8 days of the month, as you know. So as we weren't able to deliver those cars from March, unfortunately, we were, everyone in the sector was unable to unlock those bonuses. So our gross profit last year was impacted because we didn't unlock those sort of higher band bonus target payments, whereas this year that's kind of come through. So that's one of the things that's driven that new car margin. But I think the new car margin really is now just has more normalized, because of course, whilst there is supply shortages, manufacturers are still setting targets for us, and we still have to hit those targets. So what we've seen in terms of used car appreciation, which has been totally unprecedented because of the new car supply shortages, that hasn't really gone up in the same way.
And in terms of switching this onto after sales, and we've recent years everybody's been talking about the opportunities in terms of revenue in after sales, and you've reported a 34.8% increase in after sales revenue. Do you want to walk us through why that is? And obviously we've had all the news last year of the deferment and that of MOTs and things like this, where people have not been able to get out to get their cars serviced in MOTs. What have you got to share on that?
Yeah, I mean, actually, our after-sales performance was pleasing. I think, it would be the one area that if I looked at our business and looked at sort of, when you're at sort of 40 plus 46 on new cars and, plus 51, you could maybe argue that was a little bit down. Don't get me wrong, it's pretty hard to complain against 34%. But I do think there were some unusual dynamics insofar as, last year we had that sort of massive bounce back when we reopened. You then also had we have experienced a lot of issues in terms of pinging. I mean, just in the last 2 months alone, we've lost nearly 5,000 hours in our workshops. So through people having to isolate because of the various pinging that's been going on. So I think we've lost some opportunity there. If I'm perfectly honest with you, again, it's a good performance, and credit to the after sales team, but that's one area I kind of look at and think, we perhaps could have done a bit better than that. But again, that's no criticism on our teams, far from it. I think it has been difficult because you've had all of the issues with people having to isolate, and as you said, this point around MOTs, there's a little, there's almost like the market's a little bit out of sync because of course they were all kind of deferred. So it'll be interesting to see how H2 goes. in terms of how that plays out.
Yeah, and I think just as you say that, I mean H2, there's obviously reports that actually there's that people should be thinking about this H2 opportunity in after sales because of lockdowns in the first quarter, the deferment of MOT that then changes, like you say, that normal seasonality renewal of an MOT. So are you fairly optimistic that H2 could be a positive for after sales based on that?
Yeah, I think so. I mean, I think the other thing that it's worth just touching on at the minute is there is a shortage of technicians out there, and I think I'm seeing that there are a lot of people going around putting some short-term actions around remuneration for technicians, and I think this has been around for some time now, but I think it really has sort of heightened now. But people have got to remember and have a look at the long term as to what's going on in our sales, because remember, the vehicle park is going to shrink, and it's going to shrink quite sizably, because clearly segment 1 is where we have the highest retention in our service department. So let's not forget the 0 to 3 park and the segment 2 park, which of course is the 3 to sort of 7-year-old age of band of age of vehicles. That has been shrinking, because clearly since the Brexit vote in 2016, where the market was 2.69 million, the market's been declining every single year. And let's not forget what happened last year. We saw massive drops of 1.6 million new cars. This year the market's forecast to be 1.8 million. So you can see that's a huge drop. So segment 2 is going to shrink because of what's happened this year as a result of the pandemic and new car supplies, just as it did last year because of the pandemic, and it has been doing that for some time. So I think, whilst there is some pressure in the system now because there's a bit of a backlog and people are out there trying to fight for technicians, you've got to look longer term and say, okay, if segment 1's shrinking, segment 2's shrinking, are the actions that people are taking really sustainable for the long term? And again, as EV kicks in, a simple slide that I saw some time ago, you sort of have to have the equivalent of 2 EV cars, is how I'm thinking of it, for every one internal combustion engine. So again, in the medium to long term, we are going to see some pressure coming in after sales, and that's something we need to be really alive, which is why we are very focused on used cars, and which is why we're focused very much on servicing older cars. But of course, that's not an easy crack to sell. So I think hopefully we'll be able to maximise that opportunity in H2. But again, one of the things I think we as an industry need to be really alive to is segment 2 and 1 has been shrinking, and that is going to come under pressure downstream.
And Dash, turning to acquisitions, can you take us through the significance of the JLR site in Cheltenham, which you acquired, which brings you up to 16 JLR businesses, and the Nissan business in Leicester? You added both of these sites during the first half. And can you also tell us when they're likely to start making a contribution?
Yeah, so in May we completed the acquisition of Cheltenham and Gloucester Jaguar Land Rover. And again, for us, it was a kind of textbook acquisition that was brought to us by the brand, and it was really bang in line with our stated strategy to grow scale with our existing brand partners and extend our geographic footprint. And something, Curtis, you've got bored of hearing from me over the last 14 years. It's probably a lazy CEO could probably do it, coming up with a better strategy, but there we go. And I think one thing I'd say is, whilst this business has been loss making, I think we've got a really strong track record with the branding. Last year we were ranked the number 1 dealer group for Jaguar, number 2 for Land Rover, and so we've got a really strong track record with them. And clearly the acquisition takes us now to 16 franchises, as I said, and makes us actually now top 3 in volume. So whilst it has been loss making, and it might take a little bit of time to turn it around, we feel pretty confident about the prospects of this business given our track record with the brand. Worth saying, we've also acquired, as part of that deal, £4.5 million worth of land where we're going to build a new state-of-the-art arch concept facility on it in due course, which I think is going to be a fantastic representation point for the brand in that territory. I think also in terms of Nissan Leicester, again, similar sort of textbook acquisition for us, brought to us by the brand. So again, in line with strategy, and it's contiguous to our operations in Grantham and Lincoln. And for us, Leicester's a market we know well because we've got a number of brands there. So we've got Seat there already, we've got Honda there, and Skoda. So we know Leicester really well. And again, we've got a really strong track record with Nissan. And I think this business is, making a small loss today, but we're top 3 on the Nissan balance scorecard. So again, feel very confident with our track record with Nissan as well to get this business absolutely rocking and rolling.
And I think Curtis has given me this question to me this time, and because I think last time you gave him a stock answer, I'm not really expects for me asking the same question this time around. But we have to ask, in terms of pipeline acquisitions, what have you got at the minute? I mean, just what you've run through there, you've obviously got a lot on anyway, and you've alluded to some of these kind of things that you've got there. Have you got anything that you're eyeing up? I mean, I think last time we spoke, you mentioned the number of opportunities that come across your desk on a regular basis. Is that still the case? Is there still an abundance or a flow of opportunities that do get presented?
Well, you know what, actually, guys, the reason why I wanted to have you guys last was because I was going to tell you of an exclusive acquisition. I'm going to be buying about 100 dealerships next week. We're going to be doubling our revenue and quadrupling our profit, and the share price is going to go up about 500%.
Just bear me a sec. I just need to go and buy some of them shares, Dash. What were you
Yeah, I've just tweeted that, Dash.
Come on, guys. Can I really answer that question every time?
I know.
I'm CEO for a public company. Really? No. Okay. So I'm going to give you my standard answer. That I get asked this. I've been asked this all the time. So I can't obviously reveal what we're up to. But I love you for trying, though. I love you for trying. One day you're going to catch me out, and one day
we won't, and I'm sure I get a phone call telling me to cut it.
My standard answer. If you go back to previous interviews, I say the same thing. So look, we're an acquisitive group. We have now bought and sold 170 businesses since I took over as CEO. So we're just about getting the hang of it. We've got a really clear strategy, and Curtis can probably recite it, is to grow scale with our existing brand partners and extend our geographic footprint. And, whilst we are approached with a lot of transactions on a regular basis, we only do acquisitions where they make strategic sense for the business and where they make financial sense for our shareholders. Curtis, you must have heard that about 50 times off me over the years.
Well, yes, and it was word perfect, so well done, Dash. But yeah.
It's just for those listeners that may not have heard it, Dash.
Yeah, exactly.
Sorry. I'm being a bit mischievous, which is so not like me either.
It's been a long day, though, hasn't it? That's not good ourselves. I mean, I suppose reality is that, as you say, it's the market is always fluid, isn't it? So, and I think this year is probably no different than what it was previous years, and probably no different than what it will be next year. So, we'll just keep watching and listening.
I think what I would say is, look, we are acquisitive. As I said, look at the number of businesses we bought. We bought the 3 franchises this year already, and I think the other thing I'd point out to you guys is, we've got 57.2 million of cash. So, we need to deploy that capital, or we need to return it to shareholders. It's their money. So, hopefully we can find appropriate acquisitions that fit that strategy. But what I'm not going to do, because this question came up a lot today around what are you going to do with all this cash? And I just said, look, I'm not under pressure. 14 years as CEO, we've just had our AGM in May and got a 100% shareholder vote, so the shareholders have confidence in the management team. And I think part of that is around doing the right things. And just because we're sat on a load of cash, we're just not going to go and buy just for the sake of buying. We'll buy good quality businesses with good brands in good markets and businesses that are aligned to our strategy. And if they come up, great, fantastic, we'll go for it. If they don't, then so be it.
Well, thanks for that, Dash. The final question for you. You mentioned right at the beginning about the tailwinds and the headwinds. So interested in your view on some of the uncertainties facing the sector between now and the end of the year, and indeed going into next year, especially with regards to the supply of both new and used cars, the expected realignment of used car values, and of course the ongoing impact of the pandemic. So what are you seeing on the horizon?
Yeah, so it's a really good question, Curtis. I mean, I think this is a really, really interesting situation because, I think the topic of semiconductor chips has been around since the start of the year. But I think we as the UK market haven't really sort of suffered in the first half. And I think part of this is because many brands stockpiled at the end of last year, which was absolutely the right thing to do because they wanted to sort of mitigate any potential impact of Brexit. If in the event of a no-deal Brexit. So I think the situation is quite hard to call, and what we're seeing is many of the national sales companies who have done a really good job under tough circumstances. They've got limited information from their factories as they're making complex decisions around production allocation. Now, I'm not going to name any specific brands because I never like to do that because it's not my place to do that. But we are seeing a number of them stop production and reduce production in certain cars in order to sort of, maximise certain vehicle sales. So it is hard to call for the UK. I think the other thing is, the shortage in new car supply is going to lead to shortages in the used car market, and of course the reason for that is because a significant amount of what we supply through our used car business comes as a result of a new car transaction, either directly or indirectly. So think about it for a second. Typically 83% of new cars that we've always sold are on a PCP. Well, of course, if that customer's coming back to renew their PCP and they can't get a new car, well, what are they going to do? But you can't get access to that car, can you? Because it's not coming in. If you've got demonstrator sales that you're doing, or courtesy car sales, a lot of our brands have said don't sell your courtesy cars at demonstrators because you won't be able to replace them because they want to fulfill retail customers. Likewise, lease companies or rental cars. I mean, I'm aware that a lot of manufacturers have stopped selling to rental companies, which is, by the way, a good thing because no disrespect to the rental companies, but of course it does damage RV. So, all of this is good news. The challenge, of course, is how long is this going to go through? Because, when you've got that new car supply being affected, that then flows through to used. And, that's what's driven the unprecedented residual value increases we've seen. And I think, if you look at the rate of depreciation, I mean, it is just phenomenal. It's just phenomenal what we've seen. I mean, between April and August 2019, residual values dropped as they normally do by 9.4%. This year they've gone up by 17.6%, and that's a difference of nearly 27%. So, I was sort of saying to somebody today, just to get your head around that, if you had a 20 grand car in 2019, between that period, it would have dropped by £1,870. What's actually happened this year, it's got up by just over £3,500. That's a difference of £5,390. So the market's fueled by all of these dynamics, and that's clearly what's been a big part of our performance in the first half. When does this all normalise? Is anybody's guess, because if anybody could have predicted this, what they would have done is they would have basically bought every used country at any price and had it appreciate on their forecourt. But it's really hard to say. I mean, and one of the things, I think, I try to, I'm really data focused, and I like to read a lot, and I like to study the markets, and I've been reading a lot of the commentary from the global OEMs to sort of get insight as to what's going on there. And it's quite clear that some of the leaders of our partners on a global scale are saying that this could be out to 2023, 2024. I've heard one manufacturer say, so for one thing's for sure, this is going to carry on through till 2022 is my view based on what I'm seeing. As I said, it does vary brand to brand. And you could see some interesting dynamics insofar as, does it mean that used cars remain very strong? We know we've got a reduced vehicle park, as I was just saying earlier, because the number of sales have been reducing since 2016 with the Brexit vote. But it's going to be fascinating, that's for sure. And I think, we've got to be very savvy in the way we run our business. And I think, that's what we focus on. And we can't control the market. We can't control what other people do. All we can do is look at ourselves in the mirror and say, okay, what is it we're doing today on a day-by-day basis to drive the business forward? And that's our job.
So I suppose, do you believe then, I suppose, you don't want to, I don't know, I suppose where you're coming from really, but the second half of the year potentially could be a bigger challenge than what we may have seen in the first half of the year because of that stockpiling, because of the stock and pipeline and the continual challenge of supply. And obviously we've just out this today in terms of the used car results for the second quarter, which, as you said right at the start of that, this is SMMT data, which does obviously pick up those vehicles going into the SORN and things like this, and change of private ownership, not necessarily retail sales. But that was a fairly positive result for the second quarter of used car transactions, which, do you think that's distorted because of that? And we actually, the second half of the year, we need to keep a close eye on what's happening now for the third and fourth quarter.
I think we do, and I think I do think it'll, it's anybody's guess really, but I do think it will hold, because what we're seeing is supply for quite a number of our brands is impacted. So I think whilst you've got those supply challenges in new, that will then lead to supply challenges in used, and I think that will hold margins up. The problem is, though, can you compensate by margin in terms of what the volume drop will be? And that's the dynamic that I think is going to be interesting to see what happens, and it's really, really difficult to call, because a margin increase does not compensate anywhere near if you're 20 or 30% down on total volumes, unless of course you're going to significantly improve your margins to compensate that. But that's not an easy thing to do. So it will be interesting. I think also don't forget last year, when you look at that Q2 data that's been released this morning, yes, it was up 108% or whatever it was, but the reality, we were locked down for Q2. So it will be fascinating, that's for sure, Phil. I mean, so one year hopefully we'll go back to having a normal year, because we've had WLTP, pandemic, election, no deal Brexit. I mean, it's just bonkers, isn't it? But
is that a hope? Is that a hope that we go back to some kind? Is there ever going to be a normal seasonality return into the sector? I think is the big question. I think we've seen, as you say, we've seen such turbulence, haven't we, over recent years, and we're now moving into, obviously, the EU exit, the TCA transition, and obviously that transition towards electrification. You just wonder whether actually will we ever, in the short term, return to any kind of normal seasonality. I don't know.
I mean, I do think some of what's happened is going to, you think about, for example, that MOT thing we were talking about. I mean, that's pushed out MOTs now abnormally into the second half of the year. So we've got to, all of us collectively as an industry, start thinking about our working patterns, how we, when we let technicians have time off, because as I said earlier, I look at our 34.8% up, and whilst yes, it's a great performance, actually, compared to what we did in our new car and used car business, actually it was off the pace. So was that because we didn't plan? Was that because of pinging? I don't know, but these are the things that when we're planning for our businesses, we need to be thinking about a bit more strategically, and a bit more smarter in the way we do things. And we've got learnings that we can take there, but also how does this all play out moving forward, when you think, okay, you've got supply shortages, then you've then got the after sales part that is going to reduce. I mean, that I think is a big part of what will be a dynamic that really impacts our business for the next 2 or 3 years, because after sales is going to come under pressure. So that's what I said earlier, let's not think short term, because you don't need to be a genius to work out, if you've been selling less new cars over the last 5 years, it is going to come under pressure. So that's why we have to focus on selling more used cars, making sure that we do all the basics well around EVHC, around red work upsell, and just doing the basics brilliantly well, and that's our job.
Yeah, no, I couldn't agree more. I think, like you say, we've handled it well. I mean, just to summarise, I mean, your results for the first half of this year kind of demonstrate the capabilities of the dealer network in the UK, and resilience, coming out with those results in the first half of the trading, when Q1 was predominantly in lockdown with click and collect only, and with shortage supply of new and used vehicles as well, is a phenomenal result. So again, hats off to you and the team for the fantastic performance there, Dash.
No, thank you. Thanks, guys. Really, really delighted to be back on the show. You guys did a fantastic job, and I listen to you pretty much every week. And keep up the good work, guys.
Nope, same to you. Keep well, keep safe, and you're welcome back on anytime. You know that, and we'll catch up again soon.
Yeah, many thanks, Dash. Great to catch up with you.
You too. Bye bye.